So thank you, Chair. Okay. My talk will be about the not debt restructuring, but what I would call the debt system. That means the structural conditions that put Global South countries, and especially African countries, in recurrent patterns of debt distress. The title of this panel is The Political Economy of Debt Crisis Resolution. I don't think that there is something like a debt crisis resolution. I would say that you have debt crisis postponement in some sense, but not debt crisis resolution, because the debt crisis in the Global South, and especially in Africa, are something structural. If you just look at the data about, for example, the external debt, public debt, GDP ratio in Africa, from the 1980s to the 2000s, during structural adjustment plans, we could see that the structural adjustment plans under the IMF and the World Bank did not decrease that ratio. So the purpose of the structural adjustment plans is not to put African countries, Global South countries, in a better health, economically speaking. I would say that the goals of structural adjustment plans is first to erase resources that could be claimed by foreign investors, foreign direct investment, and also the creditors. A second goal for me is that through structural adjustment plans, they could first denationalize Global South economies. For example, asking these countries to liberalize their banking sector, financial sector, but also most of their extractive sectors. That's, for example, what we have seen in many African countries. If you look, for example, at the report made by the World Bank about the impact of structural adjustment plans in my country, Senegal, they said that, well, one good thing that has been achieved is that the banking sector, financial sector, has been totally liberalized for the benefit of foreign capital. So I don't think that with IMF, schemes of debt restructuring, you could solve debt crisis. You could only postpone that. So what made the debt GDP ratio, even if you know that this is a very problematic indicator, decline, were two factors. First, debt cancellation under the HIPIC and the multilateral MDRI. The second factor was better prices for African commodities. And in fact, the problem we have is that we don't have good terms to access foreign finance, and at the same time, we couldn't have access to good prices for our raw materials. And that's why most African countries are locked in a pattern of debt crisis. But the thing is, even the most generous form of debt restructuring will not in itself end debt crisis. It will only postpone them. And you could see that with what happened during the 2000s, because we had significant debt cancellation. If you take, for example, the case of Zambia, a country that defaulted, just after the pandemic, you could see that in the case of Zambia, the public external debt, public and publicly guaranteed, went from 138% of GNI to 8%, less than 8% in 2006. And 15 years later, Zambia would default on its debt, despite the fact that Zambia enjoyed a super commodity cycle where the prices of copper increased by a factor of 4 or 5. So that means you have no longer any significant foreign debt. You have a good economic cycle with better prices for your commodities, and afterwards they tap the Eurobond markets. But just with the pandemic, this country defaulted. So what happened? And this is linked with the behavior of foreign direct investment. In the case of Africa, we could not talk about foreign debt without taking into account foreign direct investment. Yet, foreign direct investment is generally absent of the debates on debt in Africa. Why foreign direct investment is important? because foreign direct investment in Africa is mostly located in the extractive sectors, oil, gas, mining, agriculture. And the thing is, most of our export income comes from these extractive sectors. So generally, the debate is about the terms, conditions, and costs of finance, but not about the foreign earning capacities of global South nations. And African countries, most of them are resource rich, so they should be net creditor to the rest of the world if they had technical and fiscal control over their natural resource sector. But that is not the case. So what happened in the case of Zambia? In 2006, the debt went from 128 to less than 8%. So debt cancellation. But at the same time, the foreign direct investment, profit and dividend remittances went from, let's say, 1 billion to 5 billion. So the income remittances by foreign direct investment cancel to some extent the debt cancellation. And at the same time, due to the way the debt, the previous Zambian debt crisis was managed by the IMF, in fact, Zambia could not benefit from the boom in copper prices because the terms of the restructuring was that Zambia has to privatize for the benefit of foreign capital its copper sector. So when the commodity boom happened, Zambia got nothing, out of the copper sector. So it did not accumulate foreign exchange. And at the same time, profit and dividend repatriations were increasing. And that has been the pattern you could see in most commodity-rich countries in Africa. Two countries have defaulted on their debt, Zambia and Ghana. And if you look at the data between 2000 and 2020, you would see that the foreign direct income repatriated abroad has been systematically higher than interest payment, external interest payment, and over this period have been systematically higher than the debt service, external debt service, despite the high interest rates on the bonds issued by African countries. So that means we have a problem with foreign direct investment. And this has been the talk yesterday by Leons Ndikumana. African countries should be net creditor to the rest of the world, simply due to many things, including also the corruption of the elite, a lack of developmental state. They don't have technical and fiscal control. And as a result, even if they have commodity booms, they do not accumulate foreign exchange. The other thing is that when these countries also issued bonds in international capital markets, Euro bonds, they did not use that well. Why? Because they used that debt to service part of the existing debt. The other thing they did is that they used those loans to finance infrastructure project, but very particular infrastructure project. Infrastructure project that do not deliver US dollars. So that means you borrow in US dollar, you finance infrastructure project that could be highly profitable in domestic currency, but this infrastructure project will not deliver the US dollars. So that means that to service the loan that help you finance the infrastructure project, you have to rely on your traditional source of foreign income. And if ever you have a crisis like the pandemic or like the Ukraine-Russia war, you could have a problem. And many countries did that, Ghana, Kenya, Ethiopia, etc. So that means that when you borrow in foreign currency and you invest in projects that could be profitable but that do not generate US dollar, you could have a problem when you have a negative shock affecting your traditional source of income. So my point is that, like Leon said yesterday, in fact, most African countries should not be in a position of debt distress. If they had a real control over their natural resource, they should have been in a position of debt creditor, or at least they should have issued fewer debts in foreign currency. And you have two examples in Africa. You have two countries that are not living any debt distress. You have Botswana and you have Algeria. What are their characteristics? Botswana is really a resource-rich country because they export diamond. And if you look at the data between 1960 and 2000, the three countries that obtained the highest rates of economic growth was Botswana, China, and South Korea. And Botswana, if you look at their debt service, it's something like 0 and 2% per year. Their debt service is out of their foreign earnings. You look at Algeria, it's 0%. But what is interesting in these countries, which are net creditors, is the fact that, in fact, they impose themselves austerity, despite the policy space they have. So you have countries that are net creditors to the rest of the world, that have significant policy space, but they are not doing that. So that means that even for countries that manage to have a significant national control over their oil resources, over their natural resources, they are still in this self-imposed constraint of austerity. In Botswana, for example, the unemployment rate, despite the limitation of this indicator, is something like 25%. So they are not doing that. So that means that the kind of first industrial policy you must have is to have a national control over your natural resources. That is really important. And my last point will be about the inadequacy of the current international financial system. And you could see that as long as we have a key currency standard, be it called the US dollar standard, in fact, it will be impossible for countries in the global south, especially commodity producers, to achieve a kind of a painless green transition. Why? Because the countries that manage to escape the debt distress are those who could, accumulate US dollar deposits through the sales of commodities. So that means that countries that could, exploit oil, gas, mining, and continue the extractivist patterns, those countries, if they have a national control over their resources, they could manage to escape the debt distress. But if we say to these countries, now we are going to divest in these sectors, and you will always have to accumulate US dollars to pay for your imports, that means it's impossible to have a painless global green ecological transition. So that means that this key currency standard is not fit for purpose. And for African countries, we could see really the problems. That means that you could only escape the debt distress when you are a commodity producer by first destroying nature. But if they say that you have still to use dollars and no longer use your commodities, so that means that, well, you have to be poor. Thank you for your attention.
So I just want to make 3 points like that. I just want to make 3 points to complement Ndongo. He started by saying that one of the major impacts of several decades of structural adjustment programs was to denationalize African economies. And he's spoken quite a bit about what has happened to the natural resources sector, and the natural resources sector being an important part of a restructuring of the ownership of the natural resources, and this benefit being an important part of the future of Africa's development and the reduction in the dependence on external resources. I wanted to add one more area in which I think 2 to 3 decades of structural adjustment programs have attacked the African economies, and that is in the area of agriculture and food. The food system on the continent still contributes to more than 50% on average employment and more than 30% of GDP. But the food system was one of the areas that experienced one of the most radical restructuring. So before the 1990s, the Africa's share of imports as a share of food consumed on the continent was less than 5%. From the 2000s to date, the percentage of mechanized food imports as a share of mechanized imports now exceed 30% in some countries, but averages around 20-25%. In some countries, food imports as a share of GDP also exceeds 30% and increasing. Now, why is this so? The continent was sold a story as part of the trade liberalization agenda that you did not need to depend on food production. You needed to create an environment in which you earned foreign exchange and you increased access to food, which means you are able to acquire food in the market. The first attack was the removal of subsidies for food sector agriculture. But subsidies remained in many areas of the commodities that were exported. So in the case of Ghana, for example, although by value, the staples such as cassava and yam are far higher than cocoa, for example. Cocoa receives protection, minimum prices, subsidies, but not the food sector. So commodity exports, that which was not food, was prioritized and continues to be so. This led to two things. One, the increased dependency on food imports, and secondly, the permanent change in incentives within the sector, in the agricultural sector, favoring the production of commodities that were not food, and in particular, the production of commodities, commodities that were not were not protein oriented. So where crop production increased, it was in the staples, and the impact of that has been increasing malnutrition. The fastest subsector demand are in protein-related growth, which is pulses, meat, dairy. In these areas, almost across board, across the continent, they are 80 to 100% dependent on imports. Urbanization has accentuated this, which means the dependency on critical food commodities, the imports of critical food commodities is increasing, not decreasing. Now, this is a very important point to make, because if agriculture is the main source of employment, and it is potentially the main sector of potential transformation, declining agriculture and agricultural productivity increases dependency across the board. The second thing I wanted to say was the area of infrastructure financing. So one main source of balance of payment pressure on the continent has been the desire, the need to finance agriculture, infrastructure. So the infrastructure needs have grown with population and have grown with urbanization. And so the African Development Bank has estimated that the infrastructure financing gap annually is between 100 billion to 170 billion, depending on how you calculate it. Now, the source of financing infrastructure in the past has been concessionary finance. Concessionary finance is declined and declining, leaving basically countries to either depend on mortgaging their natural resources for infrastructure financing, which is mainly the way the relationship with China is structured, or being encouraged to raise short-term capital from private capital markets to finance infrastructure. So much of the Eurobonds, the commercial borrowing, went into infrastructure with a serious mismatch between mismatch of returns and servicing. So short-term borrowing for the financing that takes a long time to make returns. Now, the only source of financing infrastructure increasingly is, as somebody mentioned yesterday on blended finance, is increasingly pushing these countries to the commercial finance market. And this has to break at some point. And the more we go in this direction, the more difficult it is to break, to reduce the balance of payment crisis and indebtedness that face the continent, which means that we have to think about concessionary financing once more. And the unfortunate thing is today, for the last 2 days, we haven't really discussed the role of the World Bank and the development banks that much. But the World Bank reforms that increasingly positions the World Bank basically as an organization that de-risks private capital, means that even the World Bank becomes more and more an instrument for serving the interests of the bondholders rather than being a source of development financing. So we do need to also pay attention to the World Bank as we discuss the role of the IMF. The final thing is that this is particularly important because, as Chandru was saying yesterday, many African countries, starting with Ghana, and increasingly many will come on board, now have this double austerity. So the restructuring, the external, structuring to save resources, to pay external debt, and then domestic debt restructuring. Both of them combined, creates a double pressure on public expenditure without the promise of what debt restructuring in the past was meant to achieve, that you exchange short-term austerity for the possibility of accessing the development finance that enables you then to return to the path of economic growth. So we have a restructuring process that undermines domestic lending and domestic economies, domestic expenditure, at the same time has no pathway for the concessionary, for the financing of development. That means this would be a repeated series of IMF programs. As somebody said, some countries have already gone to the IMF 16, 17 times, are continuing. It will be a repeated process unless we break this barrier between short-term austerity and the return to a growth path through a more varied source of financing. Thank you.